Hi everyone. We published a piece recently titled "The 3 Reasons Why Megatech Growth Stocks Are the Best Value Stocks Today." And I just wanted to share with you the key takeaways from our analysis. So there's no doubt that the world's annual $120 trillion economy increasingly depends on just 6 megatech businesses. So that's Facebook, Alphabet, Microsoft, Amazon, Tencent and Alibaba. And you would think that they would continue to all be obvious inclusions in global equity portfolios today, and yet many investors have a lot of reasons to avoid or even sell these megatech investments. So these include the idea that after a strong 2020, many investors are worried that perhaps all the easy money has been made, which is a commonly used phrase we hear in our industry, but doesn't make a whole lot of sense to us. Some investors are worried inflation will drive interest rates higher and compress the earnings multiples of these higher growth businesses. Megatech investments also seem boring now to many investors. And of course, there are the never-ending headlines pointing to regulatory pressures across the sector. Yet our analysis shows that megatech stocks not only offer some of the best growth opportunities, but also offer some of the best value opportunities in the market today. We see material upside in all 6 of these megatech businesses. And given the combination of strong and growing advantages, enormous growth opportunities, and material undervaluation, we believe these names should form, or continue to form, the core of any global equities portfolio. Said another way, investors shouldn't rotate out of megatech to value because megatech is value. At Montaka, our investment philosophy is to own the long-term winning businesses operating in the world's most attractive markets without overpaying, of course. These megatech businesses meet these criteria in the strongest way we've seen, and they form the core of our portfolio today. So let's take a look at the top 3 reasons why megatech stocks are some of today's best value stocks. So the first reason is that the business quality of today's megatechs is among the highest that humans have ever created. They dominate global data, benefit from enormous ecosystems, and have superior economics and scale. The huge cash flows and profits these businesses generate can be reinvested in new business opportunities, spurring fresh rounds of growth. These megatechs all have a vast array of high probability growth options in enormous new total addressable markets. So if you take Facebook, for example, which is Montaka's largest holding today, more than 3 billion members log in and spend significant time each month on its platforms, and it is unquestionably the world's best platform for marketers to reach customers. Facebook's revenues and earnings have been largely driven by the company monetizing around 10 million businesses who pay for the company's digital marketing services. But approximately 200 million businesses use Facebook today and another 200 million individual creators. So Facebook is now investing heavily in its conversion and monetization capabilities, particularly in e-commerce and creator monetization tools, to unlock this enormous latent revenue opportunity of these currently non-paying businesses and creators. That gives us great confidence that Facebook's future revenues and earnings will be multiples of its current levels. Or take cloud computing, for example. Amazon, Microsoft and Alphabet, along with Alibaba and Tencent in China, dominate the cloud. Microsoft CEO Satya Nadella estimates there will be approximately $8 trillion in incremental IT spend each year globally by 2030, of which cloud-based services and applications will no doubt claim the lion's share. For the leading cloud providers, their advantages in scale, data, and customer captivity will only continue to strengthen over time. Said another way, this is a space for which enormous growth is largely assured and for which the winners have already been defined today. This means that the future revenues and earnings power of these businesses will also be multiples of their current levels, and we believe this is not being priced in today. The second reason megatech provides fantastic value is that investors are too worried about inflation and what that could mean for interest rates and valuations. Over the first 6 months of this year, equities in the tech sector have underperformed the broader market, largely because investors feared rising rates would slash tech valuations. But those fears and the sell-off, we believe, are overdone. While we note the same strong headline inflation numbers that everyone else sees, we struggle to see an extended acceleration in core inflation. For a start, over the short term, there remains significant slack in the labour markets relative to pre-pandemic levels, which should limit the acceleration in wage growth. Secondly, our analysis of Chinese credit growth shows a clear and substantial slowing, which is a strong leading indicator for cooling global commodities demand growth over the next 6 to 12 months. And we also expect the structural disinflationary forces such as the ageing populations, labour disrupting automation technologies, as well as global corporate and government indebtedness to persist for decades. The final reason that megatech stocks are great value is their attractive valuations. Our analysis shows that the expectations baked into the current stock prices of our big tech names are far too conservative. So we give a number of examples in the written piece that we published, so let me just give you one here today. And again, we'll use Facebook, which is again our largest position. So Facebook is currently priced at a forward earnings multiple of around 14 times, or at least it was when we wrote the piece. Some of the businesses trading at a higher multiple than this today include Australia's Wesfarmers, Scentre Group, and plumbing parts supplier Reece. We don't think that makes a lot of sense, nothing against those businesses. So at the current stock price, the market is effectively giving investors all of the upside from e-commerce, the monetization of the creator economy, WhatsApp, Messenger, Reels, as well as Facebook's growth in virtual reality and augmented reality, all for free. As the global economy grows, we are all becoming even more dependent on the highest quality megatech winners. Today, the collective revenues of these businesses account for just 1% of global GDP. By 2030, global GDP will probably be around $160 trillion per annum, and these businesses will likely account for a much larger share than this today. When you combine a growing share of a growing economy, the future upside of these megatechs is really spectacular. Yet the market is underestimating that in our view. So for the patient investor who can look through the short-term noise, we think the rewards will be substantial. We believe these businesses are very strong candidates to form the core of any global equities portfolio today. At Montaka, we will continue to own these businesses in size while their prices make sense. So patiently owning the winning businesses in the world's most attractive industries without overpaying is the way Montaka believes in safely compounding capital over the long term. Talk to you soon.